Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 7th of July. I'm Daniel Lam, your host for the podcast. I used to do some boxing when I was younger. Like a fair number of people who also like the sport, my favorite boxer was Muhammad Ali. Now, one of his most memorable quotes was, "I'm so fast that last night I turned off the light switch in my hotel room and I was in bed before the room was dark." Now, this reminds me of how fast the change in narrative has been for US equities. At the beginning of the year, it was all about US exceptionalism. Then over the last few months, people were talking about diversifying away from US assets. And now, after the stronger than expected non-farm payroll number and the big and beautiful tax bill, some providers are talking about US exceptionalism again. But we need to put things into perspective. Yes, the payroll numbers did beat headlines, with 3-month average running at a solid 150,000. The unemployment rate also dropped to 4.1%. But the devil is always hiding in the details. Government, education, and healthcare dominated the job gains, but private sector dynamics were actually softer. A weakening job market is slowing consumption, which is the main driver of the economy, and in May, the US real personal spending fell by 0.3% month on month. Now you can say that the big and beautiful tax bill can provide an estimated $3.4 trillion fiscal boost to the 30 trillion economy over 10 years, and this can fuel the economy again as it slows. But the market has already been pricing this in. So for example, investor positioning in US equities have been recovering from more than minus 1.5 standard deviation below the mean after Liberation Day back to around neutral levels. US equities is not cheap. 12-month forward PE for the MSCI US index is at 22.5 times, almost 2 standard deviations above its historical average. So we need to see sustained earnings growth in order to justify this valuation premium, but the market is projecting the earnings growth down for the quarter to 5.8% year over year from 12% at the start of 2025. So this reflects geopolitical and tariff uncertainties and the potential impact on supply chains and profit margins. Thus, investors should actually take advantage of the current strength in US equities and trim their excessive long exposure. They should be adding to other regional markets with strong domestic policy support and earnings growth projections, such as China and Korea. Now, within the US, we expect rotation into the major US banks. The sector is riding on expectations of a relaxation by the Fed in the enhanced supplementary leverage ratio for the banks and the passing of the Fed's annual stress test. And we're expecting further deregulation to help support US banking stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.